David Lafferty is joining us, Chief Market Strategist at Natixis Investment Manager. So, David, is this the relief that we needed? What comes next?
We'll certainly take it. I mean, I think what's really happened here is, sort of the de-escalation of the trade tensions is what the market's been pricing in for a while. Off those October 8th lows, the market's been grinding higher. The earnings haven't really been there, so I credit a lot of this with sort of an expectation that the Fed would be fairly dovish, along with the de-escalation of trade tensions. I think that's really helped the market. We'll take it. I'm still a little skeptical in the long run. I think so. Everybody says we've got sort of this uncertainty removed. I would agree with that, but removing uncertainty isn't the same as providing certainty. So we still have a lot to learn about what this trade deal actually is going to look like. Probably in the next 3 to 4 weeks, and we'll see if there's real follow-through. I think you saw that skepticism on Friday. Markets seemed to love the news on Thursday, and then sort of didn't do a whole lot of follow-through on Friday.
Now, David, to your point about whether or not the progress we've made with China is the end of the situation, it's probably not, right? We got to get details, and there is phase 2 expected and all that. Possibly more importantly is the fact that we don't really know what it means for earnings yet. We don't know if companies are suddenly going to start turning back to CapEx, which they put on hold. What does the evidence look like right now that we are in store for a reversal in the earnings trend for next year, which has been lower?
So what I would say is we do think there'll be a reversal. I don't think it'll be that strong. We all know sort of the kind of the way the earnings game works. Right now for calendar year 2020, bottom-up estimates are about 9.5% or 10%. I don't think it'll be anywhere near that. As we've talked before, I think with a global economy growing at 3% real, call it 5% nominal. Remember, earnings are a nominal concept. Maybe we can get 4, 5, 6% earnings this year. I don't think we'll get 10. So the question will be, will the market be let down because it's half of what we're expecting, or will it be, sort of encouraged by the fact that it's better than what we've had? I think the direction is up. I think the stock market can sort of grind higher on earnings for here. I just don't think people should be factoring in a lot of multiple expansion. You hit on a real key point here, which is, as I said earlier, less uncertainty is not the same as providing certainty. Will this hit business CapEx? I don't know that if I were a CEO looking at what we're likely to get on phase 1, that I'm all of a sudden out there building factories or reinitiating new supply chains. This sort of takes a little bit of pressure off, but I'm not sure it's going to encourage a ton of CapEx. So I think earnings will be better. I don't know that they'll be dramatically better.
One of the things I see people possibly miss a little bit, David, in this is that there is now a good piece of evidence that the global situation is stabilized for manufacturing, and that maybe if there is an area that feels better now that U.S. and China are making progress, it'd probably be the manufacturing one. Over the last year, our consumer services sector here in the U.S. has still been rocking, right? People are spending like crazy. That hasn't been the problem. But this idea that now there's going to be both components of the economy getting a boost, consumer and manufacturing, it seems like maybe the possible strength, and for companies that do feel more comfortable, would be on the manufacturing side, right? So are we potentially at an inflection point where the relative strength could change, where we've had a year marked by the relative strength favoring the consumer?
No, I think that's very possible. When you look at things like when you break down things like the leading economic indicators, anything that was tied sort of domestically has been perfectly fine. And anything that has been tied, whether it's industrial production, exports, anything that's been tied to trade or the external sector has been weak. I don't know that we'll see a massive shift there, Oliver, but again, we've taken some of the pressure off. So when you talk about where the marginal trade is, yes, the marginal trade looks like it probably should be focused more on things like materials, industrials, things that have been penalized. Those things are, there are areas of the market that are cheaper, say financials, maybe even something like healthcare. But frankly, things like materials and industrials have really had this trade headwind hanging over the top of it. Again, we don't have an all clear sign, but it doesn't look nearly as detrimental as it was when the president kept threatening these December 15th tariffs.
How important is it that we continue to monitor the nature of stuff like wages, of course, the overall potential for incremental consumer growth? I mean, I think about some of the stocks like Chipotle, Starbucks this year. The consumer companies were almost like a safety trade in a way, David, because the clarity for their driving force, U.S. spending and employment, was so obvious. Now it seems like maybe there's an opportunity for look for areas of growth that aren't so obvious. What do you think those will be? I know you're talking about some of them here on the more industrial side.
Yeah, I think you got to be careful. I mean, we see with that strength in the consumer, I mean, I think that's good, obviously, for the consumer names, generally speaking. But I worry, and maybe this is wearing too much of a macro hat, that we get a little bit of a spillover here in things like inflation and margin pressure. So while we all want sort of wages to kind of keep grinding higher, we have seen that profit margins have begun to struggle a little bit. And I think that's in no small part to what we're seeing with reasonable strength in wages. So I think what you're going to start to see is more of a bifurcation. As wages pick up, you're running two specific risks in my mind. One around profit margins and one to see if there's any bleed through into inflation and interest rates. We're not seeing it yet. The nerdy economists will tell you that isn't quite the way it works. It's not a clean pass-through necessarily directly from wages to inflation, but there is some link there. We haven't seen a huge move up in inflation, but think about what would take the wind out of the sail of this market. It would be the idea that we're getting higher nominal rates because inflation may be picking up. We don't see it yet, but it's a risk. Or that higher wages are beginning to cut into profit margins more significantly. Those two things would sort of be overhangs to the market, even though, as you point out, sort of helps out the consumer side.
Yeah, David, really good, really well said there. The other thing, before we let you go, of course, we got to talk bonds for a sec, all right? Because you and I have discussed this before. You knew we were going to go here because maybe it's just a technical bounce off of where you would expect on the chart, like we said at the top of the show. Or maybe there's something wrong here with the bond market not responding the way it should and too much duration still within portfolios across the environment. What do you make of what's happening with some of these safety trades? Bonds and gold seem like we're still cutting rates or something.
Yeah, I mean, you sort of see it at the front end. The interest rate, forward interest rate probabilities still have a bias for slightly lower Fed funds rate in the second half of the year. But when you look at something like the 10-year, we've had a little bit of a bounce here. We're up to about 185. It continues to grind higher. That's kind of where we are. We think, again, this sort of the marginal risk has been kind of taken out of the market. And so we see interest rates kind of stable to backing up a little bit from here. But frankly, with U.S. bonds being almost by far the highest yielders, I guess the Canadian 10-year might be a little bit higher. But within something like G8 or G10, U.S. sovereign yields being that high, we think there's a cap there. We think this sort of overall strength in the economy wants to make yields kind of grind a little bit higher. But it is a grind they can't pop because I think there's just so much demand for U.S. paper out there, given how high, relatively speaking, U.S. yields are.
All right. David Lafferty, really good stuff as always. Appreciate you joining us here on Monday.